You ready to pass the CPA exam faster? Visit cpapass.ai. Today, the fair value hierarchy. Master the most misunderstood FAR rules. On the FAR exam, candidates often struggle with how US GAAP measures fair value under ASC 820. The key is understanding that the fair value hierarchy ranks inputs based strictly on their observability, not the valuation method itself. The hierarchy is designed to maximize the use of observable inputs and minimize unobservable ones. This structured framework categorizes inputs into three distinct levels to ensure consistency and reliability. Level 1 represents the most trustworthy objective market data, while Level 3 relies on subjective internal estimates. A major examiner trap is assuming companies can freely choose their favorite level. In reality, the hierarchy is mandatory. You must always use the highest level of available inputs. Let's break down these levels from simplest to most complex. Level 1 inputs are the gold standard of fair value measurement. These are unadjusted, quoted prices in active markets for identical assets or liabilities that the entity can access at the measurement date. Think of checking a public exchange for the price of a share of Apple stock. If it trades at $40, your fair value is $40. The examiner trap here involves active versus inactive markets. If a market is inactive or has low volume, those quoted prices cannot be classified as level 1. Furthermore, you are never allowed to adjust a level 1 input, even if you believe the market is temporarily off. You must take the quoted price as is. Let's look next at what happens when identical quotes don't exist. When direct level 1 quotes are unavailable, we move to level 2 inputs. These are market inputs that are observable, but they are not direct quotes for identical assets. To understand level 2, use the real estate comparables analogy. If you're valuing a home, you look at recent sales of similar houses in the same neighborhood and make adjustments. In corporate finance, this includes quoted prices for similar assets in active markets, or interest rates, yield curves, and credit risks that are publicly observable. The key distinction is that the data is still market corroborated. However, if you must adjust these observable inputs using significant unobservable data, the entire measurement gets downgraded. Let's examine that boundary next. Level 3 inputs are unobservable and represent the most complex tier. We use level 3 only when there is little to no market activity. Think of the new technology analogy, valuing a highly unique patented machine with no comparable market sales. Here, the company must use its own internal assumptions and cash flow projections. When selecting a valuation technique, remember our MyC check mnemonic: market approach, income approach, and cost approach. A major examiner trap is the level 2 versus level 3 classification. If a valuation relies significantly on unobservable inputs, the entire measurement is classified as level 3. The lowest significant input level always wins. Let's summarize the critical rules you must memorize for exam day. To master fair value on the exam, remember these absolute rules. First, memorize the mnemonic exit, not entry. Fair value is strictly an exit price, the price you would receive to sell an asset, not what you paid to buy it. Second, watch out for transaction costs. You must exclude transaction costs like broker fees from your fair value calculation, but you must include transportation costs if they physically move the asset to its market. Finally, non-financial assets like land must be valued based on their highest and best use, even if the company currently uses it differently. To practice these concepts with realistic simulations and multiple choice questions, head over to cpapass.ai.